Hubert Centers here. We're going to get to the bond basics here in just a second. But before we do that, I wanted to walk you through an exercise that I think will change your mind how you approach trading and investing. And it's called risk-reward ratios. Now, this is going to be helpful for you no matter what you trade, whether you trade stocks, options, futures, forex, bonds, cryptos, or if you're a investor in startups. Risk-to-reward ratios, if you get this right, can make your life a lot better, in my opinion. For number one reason is you're probably going to be wrong more than you're going to be right, just like everybody else on the planet, right? So what you've got to do is you have to divvy up your capital or your bets or your trades or your investments for the long haul. In other words, you're not just going to bet everything on one particular trade, because if you're wrong, it's gone. So let's say you have $10,000 and you had, if you just bet one $10,000 bet on a particular trade and it doesn't work out, that's going to hurt and it could potentially blow out your account. Now, if you took a bunch of different trades, let's say you divvied up that $10,000 into $1,000 increments. Now, if you're looking to risk 1,000 in order to make 10,000, you're going to have to be right 1 out of 10 times in order to make that happen. But every time you risk 1,000, if you're losing 500, you're just going to eventually run out of money. Let me show you an example of what I mean. So this is a trade setup that I have in the bond market, and it only works about 40% of the time. And according to this statistic on the slide right now, it's 41.37%. That means that we're going to lose, and we're just going to use just basic 10 trades in a row, all right? You could do it for longer, but 10 is a really nice, easy round number for us all to look at. We're going to risk $156 on the loss side. That's how much we're going to risk. But we want to always go for a minimum of $1,000. So if we use the 10 trade example, we're going to lose 6 trades in a row times 156. We're going to be down negative $936. And you're like, man, that sucks. Well, maybe, maybe not. Let's see. And then we're going to have only 4 winning trades at $1,000 of profit, which is going to be $4,000. Then we're going to do basic math. 4,000 minus 936 is going to be a profit of 3,064 over your 10 string of trades, right? Now, when you look at that, let's say it's worse. Let's say that you're sitting here and you're looking at 7 losing trades of a loss of 156 per trade. You would be down $1,092, and you only had 3 winning trades of $1,000 a piece. That's 3,000, and on this example, you would have only made $1,908. Being correct only 30% of the time. So this is the power of making sure you have really good risk-to-reward ratios in your favor, not in the market's favor. If you were doing a risk $100 to make 1,000, you would only have to be right 1 out of 10 times in order to break even. If you were right 2 times out of 10, you'd be in the money. And if you're right 3 times out of 10, well, you can kind of see what you're looking at here. Now, a question may enter your head like, well, yeah, but I can't do that day in and day out because I'm flagged as a pattern day trader, the PDT. And I took this information from Investopedia here. And a pattern day trader is anyone that has less than $25,000 in their trading account, which, believe it or not, is a lot of people. And then also, if you're doing more than 4 trades within 5 business days. So you're going to have to be picky, right? Which is not a bad thing. The only thing I don't like about this rule is the federal government kind of puts these rules on people under the guise of they're protecting them. But if you were able to trade more and you had a good risk-to-reward ratio, I think the odds would be in your favor as opposed to them just trying to protect you. Now, you should never trade more money than you can afford to lose because trading anything or investing in anything is risky. But the cool thing about trading bonds, which is a future, you don't really have to worry about the pattern day trader rule because if you have an account with $3,000 in it, you can trade unlimited amount of times during the day and during the week. As long as you have the $3,000 in your account and you don't go negative 3,000, right? If you go to a balance of 0, they'll just turn your account off just like everybody else, right? But if you start out with 3,000 and you make some money, they're not going to care how many trades that you actually place, as long as your account doesn't go below the 0 mark. So that's one advantage of trading the bonds because it's a futures market. Now, let's talk about a little bit of fundamentals on bonds. They're fairly simple to understand. If the interest rate goes up on loans like your mortgage or your car loan or any other type of loan, if the interest rates go up, the bond prices will go down. If the interest rates go down, the bond prices will go up. That's really the only fundamentals that you need to know, in my opinion, in order to be able to trade the bond market. Now let's cover some basics. All right, so we're going to cover the months they trade, the time, the symbols, the tick values, the domes, and we'll talk about margins too, because that's pretty important. So as far as bonds go, I'm just going to talk about the 30-year bond. So it trades March, June, Sep, and December. Sounds complicated. It's really not that bad. All that means, if you were trading these things in January, you can trade them until the second Tuesday in March, and then you got to roll out of the March contract, and then you can start trading the June contract. So if you're trading in the second Tuesday in March, you now are supposed to start trading the June contract. And then on the second Tuesday in June, you'll stop trading the June contract, and you'll go to the September contract. And then the second Tuesday in September, you'll start trading the December. So they're going to rotate every March, June, Sep, and December. Now, the ticker symbols, different platforms will name them different things. For the 30-year bond on TradeStation, it's called US, and for most other platforms, they'll call ZB. So the US is the 30-year bond, and the ZB is the 30-year bond. They just use slightly different ticker symbols depending on what platform you execute your bond trades through. Now, the cool thing about the bond market and a lot of other futures markets too is you don't have to worry about, number one, the pattern day trader rule. So you don't have to worry about that anymore. And you also really don't have to worry about gaps. Now, if you've traded the stocks or options markets before, you've obviously been, if you've held overnight, you've been on the other side of a dreaded gap up or a dreaded gap down, depending on your position. For the bond market, you really don't have to worry about that so much. They're open 23 hours a day. You only have to worry about a small gap happening from the close. They open up at 6 p.m. East Coast time, and they close the very next day at 5 p.m. and then they shut down for an hour. You do have to worry slightly about a gap on when they close on Friday, and they open back up on Sunday at 6 p.m. But for the most part, they're usually pretty mild unless the Fed is just cranking up rates or just slashing them like crazy. They don't tend to move around gap-wise very, very often. I would say 95% of the time, they're really calm, cool, collected, and a methodical market to trade. Now, on the margins, they're going to be all over the place. Like, your broker is allowed to trade or allowed to charge you anything they want to on the margins. The exchanges will set the minimums, but your brokerage firm will always go slightly above the minimums just to protect them for their liquidity and their cap tables. All right. So you should always call your broker because this information can change. We're talking about the 30-year bond here. So on the 30-year bond, it costs about $3,000 to hold one overnight. But intraday, there are several brokers out there that'll let you trade a 30-year contract for anywhere from $300 to $500 a day. And some will be a little bit higher, maybe $1,000 intraday. So this would be for an intraday day trade. And this right here, this $33.75, that would be for an overnight hold. Now, remember I said you don't have to worry about the pattern day trader rule because you don't have to. Like, you could have $3,000 in your account and you could trade as many ins and outs or round turns in a day that you want to. You just got to make sure that your account doesn't go below zero. They'll just shut down your account the same way that if you were in a stock account, they would call you on margin. You can get a margin call in the futures the same way you can on stocks. Now, this is what they look like. All right. So in this slide, this is the 30-year bond, and this is how this contract actually works. So if you were to go long right here, where my mouse pointer is at 135, these things do currently still trade in fractions. Don't let that mess you up. I've got D pluses in algebra in both high school and college. So if it goes from 135 all the way to 136, that takes 32 hash marks. So in other words, from 135 to 135 and 130 seconds, that's called a tick. And that transaction is worth $31.25. For the most part, they'll move about 1.5 points a day. So you could either make or lose about $1,500 in a day. If you go from 135 and you went long and you didn't get stopped out and you held all the way to 136, that would be 32.30 seconds. That's 1 full point, and you would make $1,000. Now, if you were wrong, you would lose $1,000. Now, in this example here, I'm showing a profitable trade that I was in, and I held it overnight, and I was risking $156.32. I woke up the next day, I trailed my stop down to $375 in the profit, and then about 2 minutes later, I was able to make a profit of $1,000. I hope you enjoyed the bond basics. If you've never traded them, I would definitely look at them. Good luck. Hope it helps, and I'll see you on the next video.